In this video, guys, we are going to look at why clean charts are so important to make good, solid trading decisions. Stay tuned. Hey guys, a very warm welcome to you. Thank you for joining me. All right, so why are clean charts so important? Let me just define clean from my perspective first of all. So I think clean charts is either your standard bar chart or your standard candlestick chart. No one uses a line chart, do they? Candlestick chart or bar chart that's really got a very few, if any, indicators on. Now, there's nothing wrong with having some indicators to guide your trading decisions. There's nothing wrong with toggling them on and off, and many chart platforms allow you to toggle them on and off depending on what it's coming up to a specific setup. For example, moving average you might use as a pullback type of trade. Market comes up, market's time to pull back. You're toggling a moving average to show you, guide you, give you a little bit of a kind of clue as to where potentially the market might push on. So your clean, a little bit subjective. Pure clean will be nothing on there at all, no indicators at all, or just one indicator, maybe two max. But a kind of dirty chart, because I suppose it's the opposite of clean, right, would be something like, you know, you've got multiple moving averages on there with different settings. You've got multiple different oscillators. You've got an RSI, you've got CCI, stochastic, you've got a Bollinger Band, you've got a market profile, you've got, you know, and it just looks grubby. You've just got so much stuff on there that it's just blinding you. So the importance of having clean charts is that, and I see this a lot, guys, and listen, it's a trap that we've probably all fallen into at some point or other. You know, I think back kind of 50, well, more than that, probably 17 years ago, 18 years ago, maybe even more when I was starting out, is, hey, I need to find an indicator that works. I want to see I want to then work out back from that indicator. So I'd read all about, say, stochastic, and I'd go, right, put a stochastic on my chart, and then we go back and find all the signals. That's the wrong approach. You've got to change it the other way around. You've got to find your signals from price, and then use an indicator to help you find those specific trades. But that's by the by, that's for another video, another time. Make sure you subscribe, guys, usual stuff, if you're not already, and if you like this kind of thing. Anyway, so clarity of analysis is the first thing. The reason for that is that you just want to be able to look at the clean chart and to be able to analyze what's going on. And listen, you guys know that, you know, I'm a price guy. I like to trade price action. I like to see how price responds to events, how supply and demand shifts, all this kind of stuff. That's my big thing. It's my edge. I know what I'm good at. I know it works for me. So, and I'm not belittling indicators, because, you know, I do use indicators for certain setups, and I've talked about that freely before. But, you know, I'm just a little bit cautious about when people are using so many indicators, because to me, and listen, again, I never ever say that someone shouldn't do something, because people trade in different ways, and there's people who are very successful using different strategies. I'm definitely one of these people that say my way is the only way to trade, because I know that it's not. But I just feel that if you are putting too much stuff on your chart, you're not giving yourself the very best chance for success, in my experience. And again, this is all I can do, guys, is share with you my experience with things, and you can kind of resonate with you and go, yeah, it makes some sense, I'll try it out, or it doesn't. You know, that's the way it works, isn't it? So clarity of analysis, it gives you the focus, clean, just to see what's price doing, where's it been, how's it got there, where is it now, where is it within a range, where is it within the month's range, the quarter's range, where's it been, how quick has it got there. And that's a lot easier, I think, to see when you're just looking at price. This is the big one though, there are no conflicting signals. I see this a lot with a lot of traders, is that they have all these indicators on. They have all these different moving averages. You've got a 10, you've got a 15, you've got a 20, you've got a 200 or whatever. You've got then CCI and RSI, and you've got all these stuff. The trouble is, guys, is that they will give you conflicting signals depending on the environment you're in. You know, I'm a big proponent for using the right tool for the right job. So if you're trading in a trend environment, then you probably don't want to be fading an overbought stochastic, because it's probably going to be overbought for a long period of time, which is technically a sell signal if you're going by the book. There are ways of using stochastics in a trend environment, but let's not get into that now. You probably want to use a moving average, because you probably think the price is going to hug the moving average, and you're using it as a kind of pullback kind of way of adjusting how you get into the trade or add to the trade, even drawing on a trend line or a channel. So you've got this conflicting data sometimes. One thing's saying it's a buy, the other thing's saying it's a sell, and trading's hard enough as it is, guys. You've got to commit to one thesis, to one idea, and go with it, because nobody knows who's going to be right in this. So you've just got to find something that you think is right, make your decision, make your assessment, put your money where your mouth is, place your trade and see what the outcome is. What you really don't want is to have this conflicting thing where your RSI says it's a sell, your moving average says it's a buy, your Bollinger Band doesn't even know, and you're there sitting, which one do I believe? I don't know which to do. So whereas if you've got a clean chart, you can then be objective about it, a little bit more objective anyway. I'm not saying this is the holy grail, guys, but the cleaner chart means you can go, right, what's price done, where's it gone, how quick has it gone, where's it pulling back, does this make sense to me looking for a reversal, mean reversion type trade here, should I be aligning with the trend, should I be waiting until this trend runs out of steam and take a reversal, should I just be ignoring it? And I think without the clutter of indicators, that becomes an easy decision to make, because it's a hard decision, guys. Listen, we know, let's not pretend, guys, trading isn't easy. We have those decisions to make all the time. Should we get involved in it? Should we not? What should we do? How should we trade it? Position size, all these things, a lot of stuff to think about. And if we make that decision easier for us and we can keep the process the same each time, we can get better results. So the other thing is, never perfect. So the thing is with if you've got a really cluttered chart, is that you're constantly looking for that perfect lineup, right? I want the RSI to be this, I want the stochastic to be that, I want the Bollinger Band to be this, I want the Keltner to be that, I want the volume to be this, that, and the other, and you never get it. And you never ever get it. Or when you do get it, you're like, oh wow, it's the perfect setup. You pile into the thing and it doesn't work. You're like, why didn't it work? Everything was lining up. It should be this because the RSI's, all these indicators, and you just end up this real challenge, the real challenge of, hey, you know what, I'm looking for the perfect setup, and even when I get it, they're not even that perfect. So if you keep it clean, you just see the setups of what they are, which is really just, hey, how can I express this trade with the least amount of risk possible based on the thesis of the chart and a decent risk reward ratio? That's all we're trying to do with trades. We're trying to get into a trade with the minimum amount of risk, not just putting our stop tight, doesn't just mean that. It means based on the actual pattern or thesis, and with the highest reward possible. That's all our job is. And if we can repeat that and repeat that and repeat that, it'll work out. But if we're constantly trying to look for the perfect trade that's got everything lined up, we're never going to make the decision, and also we're going to be disappointed. The fourth thing, guys, is better at reading different conditions. So what I mean by this is, let's say we're in a real strong persistency of trend type environment. Bang, 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 hiking the 5-period moving average. I've done videos on this before, 5-period moving average, persistency of trend type. Things are going, check them out if you're interested in that. But anyway, we're hugging it, we're ripping. And the 5-period is a really good way to be buying as it comes down to it. Buying. Super aggressive strategy, but in the right conditions, super profitable. It's a beautiful trade to make. But you only get those conditions every so often in the market. You don't get them all the time. And so, if you're aligning yourself with that only, then all of a sudden as conditions change, you're like, well, I don't really have anything else to do, which is fine. There's nothing wrong with just being able to trade one conditions and one condition well, but I think it makes sense to have a little bit more of a broader selection of strategies. Don't go crazy, but at least being able to trade different conditions in different ways. And if you're wedded to one particular indicator, then that indicator then becomes almost useless. A 5-period moving average in a rotational environment has very little value. In my opinion, there's a setup out there that works very well for it, but I think it's a persistency of trend type indicator. Whereas if you're looking at a clean chart, you haven't got the 5 on there, or maybe you're only bringing on the 5 in certain conditions, you can start to appreciate different conditions. You can start to see, hey, you know what, we're a little bit more rotational. We're doing waves up, we're doing waves down, we're doing waves up, we're doing waves down. And you can start to see more how the market dynamics are changing based on price rather than using the indicators. Nothing wrong with it, but it just allows you to be a little bit more flexible and open-minded, I feel, when the chart is clean. The fifth and final thing, guys, is aligning with big money. It's a little bit controversial, this, because, and what I mean by big money is that big money really doesn't make the decisions based on a Bollinger Band break. It really doesn't make its decision based on an RSI. If you're talking about a hedge fund, the majority, there will be some funds out there that are driven purely by technicals, and I know this, and we know that there are fund managers who do specialize in that. There are fund managers who specialize in algorithm-based strategies, but broadly speaking, funds and people with big money to put to work are putting it based on a fundamental thesis. They're like, hey, we think this company is going to outperform over the next 10 years. Here's our position. We think this company is going to go to zero in the next 10 years and struggle. Here's our short position. You get the idea. So if we're aligning with, and I'm not saying we go and do the fundamental research and we do that kind of thing, but we can start to see potentially how that big money is flowing in or out of the asset if we've just got a nice clean chart. Because we can see, hey, we've got a nice steady trend here. Market itself has been stagnant, whereas this stock's been in an uptrend. Okay, well, maybe I can deduce from that that there's money flowing in. This has become a more of a favored stock. Maybe I need to look to align myself with a long. Whereas if you're really cluttered chart and you've got so much stuff up, you're looking at it through the lens of where's price relative to the indicator. So you start to change the frame as how you're looking stuff and the lens you're looking at the price through, because now you're looking at a reference point of, hey, it's at the upper Bollinger Band, it's overbought, it's oversold, it's this and that and the other, which is true, but the real way, the good or better way to look at it is to look at it as, hey, it's actually outperforming the underlying market. It looks like it's a strong market, this, because price has been chugging up, and you're reframing the way you're processing this. So now you're like, okay, rather than me trading it off an indicator value, I'm now, okay, I want to get long on this at some point because I believe this is a strong stock, a strong market, a strong currency pair, whatever it may be. And then you can put on perhaps an indicator to guide you if you wish. And you can then put on something to guide you a bit better to make the trade. But the point is, if you've got it all cluttered in the beginning, you don't see that clarity. All you see is it in reference to actually those indicators rather than pure price. So that's my take on it, guys. I think that the clean chart is the best. I definitely think that if you want to use an indicator, that's fine. I do think that flicking it on or off in the right conditions is a better way of doing it. But again, that's personal preference, not saying you have to do that. But perhaps if you're struggling with analysis paralysis, perhaps if you're struggling to pull the trigger on stuff, perhaps if you're lacking the confidence in your setups, maybe have a look at your charts, and if they're a bit cluttered, it can't harm to take some of the indicators off, take some of the things away, and just see how you get on. And then if you want to add bits on over time, then you can do. All right, guys, take care, keep yourself managed, whatever you're doing. Bye-bye for now.